What goes up must come down. It's true for gravity, but should we believe it's always true for the stock market? We've got some interesting perspective in this week's Fastest 4 Minutes in Finance. Hello once again, I'm Scott Inman. Well, the S&P 500 hit another new all-time high on June 14th. And one of the most common fears investors have is when they hear the market is setting all-time highs, it naturally invokes our belief that what goes up must come down. Well, of course, the market does go up and down. We should expect that. But should we necessarily fear all-time highs in the market? Take a look at this chart from LPL Research. The colored bars on the left are the average returns of the S&P 500 index since 1950, broken down by 1-month average, 3-month average, 6-month average, and 12-month average. All right, now on the right side of the chart, the colored bars represent the average returns of the index following the setting of an all-time high. In these measurements, you can see the market historically produces returns only slightly lower after setting an all-time high than it does in general. Now for the disclosure, all indexes are unmanaged and cannot be invested in directly. Past performance is no guarantee of future results. Okay, the other chart that can give us more perspective on digesting an all-time high in the market is this one. Okay, so the takeaway here is they happen a lot. That's right, all-time highs happen a lot of the time. We set 26 of them just last year, and that was during a pandemic. And you can see by this chart that they tend to also happen in clusters. We've been setting multiple all-time highs since 2012. Now, we've talked with investors who were spooked by something in 2020, whether it was the pandemic, the election, or new policies coming from a new president. Whatever the reason, they decided to take all or some of the risk off of their investments. In other words, they got out of the market. Well, now they've watched the market set these all-time highs and are caught wondering when to get back in. It's why we say it all the time. It's not about timing the market, it's about time in the market. If you're going to invest in equities, you need to be invested for the long term. And we may very well see a pullback before summer is over or in the fall, but that doesn't mean it's time to jump ship. Corrections are typically healthy. And to our point today, if you get out, how do you know when to get back in? Now, the reason many investors do get spooked by all-time highs in the market is that they may be nearing retirement, and they may think they can't afford to have that long-term mentality because they are approaching the retirement deadline in the short term. Well, it may help to not think of retirement as the end. You'll still need long-term investments to plan for a long retirement, but you will also want the money you are withdrawing near-term to be invested more conservatively. That way, if the market does come down from those all-time highs, you won't be trying to get out. You can simply ride it out. Thanks for watching.